There are some expenses that will inflate as well, but overall, I think the largest expense on these properties, at least in the current market, is the debt service.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupey as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, welcome to another episode of the Alternative Investor Mastermind. Today we are going to talk about how strong operators are able to navigate these challenging times with the dramatic rise in interest rates and also overcome some operational challenges. So I'm going to highlight a specific property. We're not going to give the name of the operator or the exact name of the complex just for confidentiality reasons, but we're invested in a number of deals with this group. They're one of the larger buyers of multifamily value add in the West Coast over the last few years. So overall, I describe them as a close to an institutional quality group. This is not the type of syndicator that 3 or 4 people got together at a conference and decided to raise some money and buy. This was I could consider a pretty sophisticated group, pretty well-connected group. And we've had some great success with them. We've exited deals previously, doubled our money even on one. So overall things were going great. However, they did utilize bridge loans, and their model was to really get in, fix, and get out. So using long-term Fannie Mae debt, the prepayment penalties make it difficult to execute that business plan. So unfortunately, even though rents have increased and in general net operating income has increased, there's still some headwinds with interest rate and minimal cash flow. So a couple things to note. Number one is, in the initial business plan, when you're doing a heavy value add, often there's not a lot of cash the first year or two. That is by design. There might be 2, 3, 4, 5% cash distributions. Really, a bulk of your return, if you're targeting that mid to high teens return, is coming from the profit on the sale. So while it's been painful for many to not receive cash distributions, overall, if the deals are still growing net operating income and growing that at a faster pace and growing it above the rise in interest rates, there's still a reasonable chance of exiting at a good value. What can sponsors do, and what sets a very experienced and well-capitalized sponsor apart? There's a couple things. Number one is their ability to inject their own cash in through a manager loan or a member loan. We've had a few deals, and this one included, where rather than make an initial capital call, the actual manager has lent some of their own money in. Sometimes that's just to keep construction going because the lender may be slow on releasing the construction draws. But lenders that are not well capitalized, I've heard a number of stories where the work just stops, the project doesn't move forward, you have higher vacancies, you're not turning units, and there's a delay in either biting the bullet and asking for a capital call from your partners, or the project just stalls otherwise. So having a good sponsor that has the money to bridge these short-term gaps is very important. Second is having the ability to negotiate with a lender. There's an old saying: if you owe the bank $1 million, you're fucked. If you owe the bank $1 billion, they're fucked. Now, on our deal, I don't know if it's $1 billion, but they have many loans with the same lender, and that lender is working with them. We just received notice of a modification where the interest rate's going to drop by 1.8% for the next year, and then it will go up 75 basis points, 0.75% the next year. So there's some interest rate relief for the next 2 years, and that actually will reduce the interest rate to somewhere in the high 4s, low 5s, which is actually, it makes it much more palatable to continue the value add plan. Additionally, they were able to raise some capital in a preferred equity position. So, unfortunately, the preferred equity does come in senior to the common equity where we are invested, but it was at a pretty friendly term. It was only an 8% rate, and the market for preferred equity is often almost double that in today's market, where they want to make close to a 16% return before the common equity gets paid. And in order to do that, the sponsor actually shared some of their management fees and what we call their carried interest or their promoted interest. So basically, the sponsor took some responsibility that the deal is not going according to full business plan, and they're essentially paying the higher return out of their own pocket rather than charge their partners. That is a sign of a good sponsor as well. And as limited partners, we are very happy about that. Lastly, it's the ability to make tough decisions as needed. On a few of our projects, they've actually made the decision to change property managers, and that's not something that you can do lightly. Sometimes you need a lender sign off, but the decision was made that the property manager for a number of these properties was really more set up to do a short-term flip, and not set up for more of a longer-term hold and a stabilized asset. So add to that that the property managers, and I've heard this not just on our one case study that I'm highlighting some more specifics, but really across the board where staffing is an issue. We've had a number of situations where our sponsors have sent their own internal employees to go on site at the property because there was not enough leasing staff from the third-party property manager. So those types of the ability to step up, the ability that your team is large enough. It's not a bunch of part-time people who have full-time jobs otherwise that club up to buy a property. It's run by a real business. That is something that's very important to us. So going back to the one project I mentioned with a loan modification, it's good that our partner had the kind of the wherewithal and the bargaining power to negotiate a pretty friendly modification. On the overall property that has 557 total units, of them, just about 10% have been renovated. And on average, the rent is up $594 or 66% above previous rent. And that's even $130 higher than what they thought the rent increase would be. And on top of that, there was 83 new leases and 290 renewals of the 557. And those average, and these are not on renovated units, these are just renewals, average increase of 34%. So even though there's some difficulties, the cost of debt is significant, the rent increases are also significant. And if we continue to have inflation and if interest rates stay high, it's because inflation is real and it's continuing. So if you're worried about high interest rates, or concerned about them, just keep in mind you can't model having extended high interest rates without continued inflation. If inflation really does drop or we go into an actual recession or there's any sort of black swan or crisis or event, that is the type of thing that would trigger rates dropping. So either you're going to model in continued rent growth, at least on this market, or at some point rates are going to drop. For over a period of a year or two, it's very unlikely that you have both high interest rates and rents that are dropping. With that said, obviously there are some expenses that go up as well. These portions of the expenses are labor, heating or cooling that are if it's not passed on to the tenants. So there are some expenses that will inflate as well. But overall, I think the largest expense on these properties, at least in the current market, is the debt service. One other challenge that we've seen in recent years is issues with eviction. Now, I came from the mortgage business where we had a lot of issues with foreclosures over the years, and in some markets it's starting to happen again with evictions. We've seen this in Georgia, we've seen this in Nevada as well, that just evictions are taking months in some cases, where in the past it was 30, 45, 60 days. So it's an ongoing issue. I think there's sometimes some political components to it. For example, in Nevada, the judges are elected, and evictions tend to be slower during an election year, which is crazy to think, but it's something we've seen on more than one property. So evictions are sometimes getting more challenging, and now that we're not generally in an election year, should be easier. Plus, we're sort of past we're past all that COVID stuff. There's really no other excuse for not paying your rent at this point, and hopefully that part stays smoother, and our operators are going to be able to continue to operate and reclaim apartments if tenants do not pay. All right, everybody, that's it for this episode. Please check out our Facebook community for Alternative Investor Mastermind. If you're a Facebook user, we're posting some exclusive content, and there's a lot of chat, even advice being provided between the members. So check that out. Also, like and subscribe on YouTube. Leave us a review on iTunes, Spotify, or your podcast platform of choice. And reach out if there's any questions you have. Reach out to myself or someone on our team at jcaminvestments.com. Thanks, everybody.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.